Good morning, everybody. Welcome back to Schwab Coaching. It's our Wednesday edition of Trader Talk in today's market. I am your host, Kevin Horner. A beautiful morning here in Denver, Colorado. Pleased to be joined by my friend and fellow coach. Good morning, Brent Morris. How you doing today?
Hey, I'm doing good. You know, when we talked to pre-show, you said, it's still, despite all that's gone on, you're still here. You know, the markets may not look to your ideal, but you know what? Life is good, folks. Life is good.
Yeah, some days it's helpful to be reminded of that. Yesterday was a very volatile day, quite the intriguing market move. We're going to look at some levels today and talk about some areas where maybe traders are starting to get a feel for things. Obviously, plenty of uncertainty remains on the table. Lots of talk around tariffs and perhaps the escalation from some of our counterparts outside of the U.S. So plenty to touch on here this morning. Thank you all for joining us. Today, we're pleased to be joined by Cameron May in the chat. He'll keep an eye on things for us there. Of course, Brent and I want to hear from you, so please put your comments and questions into the chat there. We'll try to keep an eye on things and answer as best we can. Topical stuff, obviously, we'll try to roll with your questions, but like I said, Cam will get to stuff that we're unable to. So if you're not already doing so, you can follow Brent, Cam, and me on X. Cameron May CS, Brent Morris CS, and Kevin Horner CS. Good way to engage with us outside of the classes we host. So we'd love to have your follow there, everybody. All right, let's review some disclosure detail, and then we'll get into those charts as mentioned. Of course, our conversation is exclusively informational and educational. We do not make recommendations nor endorsements for a particular approach or strategy. Trading the market. Do, however, talk technical analysis here in this class quite a bit. Remember to think of technical analysis simply as a piece of your overall investing and trading puzzle. We do not encourage you to base decisions only off the technical viewpoints. Now, in terms of our agenda, it's going to be a lot of the same, everybody. We will start with the top-down method here. We'll look at our broad indices, particularly the S&P 500, the NASDAQ 100, and the Russell 2000 before we move in to look at the semiconductors, maybe some rates, and certainly some other areas of the market. And there's a lot, and of course, everything in the market is moving these days. Volatility is high. So there's plenty to touch on. If there's, in terms of space in the market, industry groups, sectors you want to look at, let us know. We can definitely bring those into the discussion today. So with that, let's jump over to the S&P 500. Now, Brent, what I was mentioning here was the real volatile move we got yesterday. We started favorably, and I'm going to put this on a 5-minute bar, and you can see, Brent, we bottomed out in the morning, rallied into about 52.60 or so, if I'm not mistaken, on the SPX, was kind of our intra-period high yesterday, and boy, did we get beaten back pretty effectively. So it was a reminder to me, at least, that in these instances where we're quite literally in the midst of price discovery as it relates to these new policies, volatility remains quite elevated.
Volatility remains. I mean, the S&P 500 right now for today is basically flat. I would not be surprised if we see big lows today or big highs. I have no idea. We saw huge volatility yesterday. It swinging to both sides, both ends of the spectrum on that. And, that rally, that intraday rally, that's kind of bear trap type thing here, Kevin. You can't forget the overall context of what we're talking about. Now, at some point, we're going to, the markets will turn around and be bullish for more than a day or two. But right now, the overall context has been a seller's market, and that's what we're seeing. And I mean, that was a big rally. And I know some people were like, hey, this is great. That's the end of it. Well, maybe, not so quick.
No, apparently not. Because here's what I was looking at, Brent, was this, and I was actually looking at Monday's week open here, and I'm just not on my game here this morning, everybody. Let me apologize. But here's what we're talking about. That white line I drew in was that awesome 4% push right into R1. And I think it's notable, Brent, if you were watching this live and in the moment, you might have said, well, boy, I hearken back to some conversations we've had in this class previously about how to handle pivot levels and resistance 1 or S1 when we have these opportunities. And Brent, it sure looked like we danced at that R1 for about half an hour before things broke. And there was ample opportunity for the bulls to say, maybe this isn't the move I was hoping for. Great start, but maybe I should be a little bit defensive as we rally into this resistance.
Yes, and follow that down through the day. It comes down, hits that pivot point. That's the pinkish line. I think that's pinkish.
Yep.
And it kind of flirted with that for a while, but eventually it succumbed. And when it did, it broke down fairly significantly. Slight rally into the close, which maybe that's a good sign for today. And we'll see. So far, not well. It's too early to say much at this point, but not a terrible open, at least today here.
Compared to what we've been dealing with, I would absolutely agree with you. Not a terrible open. If we wanted to get a little heads up, and this is going to be just a look at how the equity futures have appeared on the S&P 500, everybody. We're not going to talk about anything other than really the level to which we've fallen. I'm going to change this chart, though, to an hourly so that we can evaluate this in a longer range. Brent, these are the lows from last week. Here's the lows from yesterday. So that this notable matching bottom down here, a little bit higher low here. Brent, this is also the 61.8% retracement of the entire move. And let me show you how I drew that real quick, and then we'll speak about this on this hourly. If I go back to my daily, everybody, you'll see I drew that Fibonacci from the October 23 low when this bull market essentially got going. So if that low is a valid low for this uptrend, well, then a lot of traders, Brent, would say 4,900 ledge needs to provide support here. And we're seeing, again, a bit of a bounce here. Now, obviously, it's way too early to call it such, but it's pretty interesting view of the futures here, no?
Yeah, absolutely. And I love when you bring in those Fibonacci levels, Kevin, because the more information we can get, any one piece of information, we certainly don't know, and we don't know no matter what, but the extra little bits of information help give us a bigger picture here, more potential areas of a turnaround. And it doesn't mean that long term any of these levels are necessarily going to stick, but it is curious how very often we see those turnarounds right at those either pivot points, especially if we're talking intraday, or Fibonacci levels. Often we'll use those longer term as well, or moving averages can be a significant level, or these are all different ways of kind of identifying support or resistance levels. Are these horizontal or diagonal lines here that we're looking at?
It's true. So we've got some approximations on the futures market there. If we go back to the S&P 500, the levels that we're watching here are basically the levels we've just created over the last week from last Wednesday into today. Let me pull back on some of these lines so that we can just look at the ledge. It's about a 450-point range, Brent, low to peak to trough just in the last week. And honestly, it's a good likelihood, given the size of that move, that we stay within that range for a bit as we figure things out. But Brent, if you're a trader who's looking more towards the actual trend, it might take a break of either of those white lines to define what our next direction is.
Oh, yeah. I mean, because we've seen the volatility, we know that these intraday moves can be huge. I mean, I don't know what today's going to happen, but if you look at the size of the candle today versus what we've seen, look at the size of the candles we've seen, especially include the shadow or the wick on those candles. Those are huge candles we're seeing. And probably, very likely we're going to see something similar today when all is said and done. And so, yeah, the lows are significant levels. The low that we hit a couple days ago is a significant level. If we break below that, that's a significant break, and that can certainly hurt that's certainly a bearish indication, a bearish break if we break below that. Similarly, the gap that we hit on, I'm not sure exactly what day that was, where the other white line is. Let's consider that. If we were to break above that, that's saying something about the
Sure.
sentiment of the market.
It is, and at least it would be. Not only is it a high in a gap ledge, Brent, but it also happens to coincide with about 5,300, that nice round figure that we tend to lean on in the S&P 500. Very common, unfortunately, but it does tell us, I mean, it's informative as traders. So 5,300, a very big level. Like I said yesterday, that intraday peak got us to about 5,265, 5,267, somewhere in there, but that's a lower high, and from which we got beaten back quite effectively here. So yeah, we can pare this down into very minute windows of time, as we did initially right off the jump there with the 5-minute bars, and yet reminder, it's gonna still be difficult. That volatility is gonna be tough to manage for a lot of us. So, stick with what you're comfortable with, everybody. If you're sitting on cash, don't feel like you have to be the first one through the door on any potential bounce. The moves to the downside have been so significant that moves to the upside on any relief bounce are apt to be big as well. You probably don't need to capture an absolute bottom tick to turn profits on a relief bounce, but you do need to be consistent in your plan and well-defined in your risk mitigation process. So make sure that you're stepping into any counter trend trade, which would in this case be on the long side. Make sure you're stepping in with a plan as to how you're going to act if things don't work your way. All right, let's look at the NASDAQ here. Now, we do have a little bit of a bounce underway here, Brent, so perhaps we're getting a little bit healthy, if you will, but I'll remind you again of the volatility. One of the big things as it related to the NASDAQ and obviously the overall sentiment of the market today, Brent, is that we've heard from China that they're going to be imposing an additional 84% tariffs on U.S. goods from April 10th moving forward. So that's certainly not a win. But Brent, I want to mention, I feel like there is a possibility for a win when the U.S. market starts to digest the continued so-called negative news, but we still move to the upside. There's a lot to be said about that, right?
I guess what I would say is, I totally agree with that. I would say kind of retaliatory type things aren't probably there. Some of them are probably kind of baked in at this point. And I guess that's another way of saying, hey, when we start seeing bad news, we've already kind of maybe baked in a little bit of a not a great scenario. And therefore the market's not going to react in a, oh, wow, that's bad scenario. I mean, the trend is already down, but that's when we can see the ends, when things are starting to look better, is when you're getting bad news, and maybe going forward it's a bad earnings or a earnings forecast, and the market doesn't react negatively. That is actually kind of a good sign, because it's like, well, all the sellers have done their deal. They're done. They've sold, and therefore the market is not really going to react negatively. And the same thing is true on the high side. When the market is rallying and good times are rolling, and you get good news and the market doesn't react much, that can be a sign of a top. So there's different signals we can use to try and identify when the market is turning around. One is looking at the price action, and then there's kind of these other factors in there, including like volatility factors as well. Looking at implied volatilities, we can look at that for some ideas. And so, we'll have to see here, Kevin, on that. But again, there's that kind of that line that we hit, the highs, the gap ledge that we hit a few days ago. That's a sign. Take a look at the RSI. We're down in that oversold area. Again, it doesn't mean it's turning around. What some traders will do is they'll look for the break out of that area above that 30 line as a more significant sign than just being in that area.
Yeah, you can see it back here, Brent. Once we got off of and through the 30 line to the upside, that's when our albeit brief rally did commence. But of course, found resistance, made lower highs, etc. We expect more of the same, because that's the current trend. That's just the path of least resistance, even on a bounce, is apt to be running into a bit of resistance at that downtrend line, the 20-day moving average, First, you got to get through the white line there on the Qs, or the NASDAQ 100 rather, at around 18,200. Going to be stair steps to the upside. Highly unlikely to be those explosive moves necessarily through, at least not through trend lines, I think, at this point, Brent, because what we've witnessed has been such a significant development that the chances are greater that we need to see more price discovery and continuation of downtrend than we do necessarily a break back upward through those trends, unless, of course, something were to change in terms of policy. One of the things that I'm hearing amongst the trader friends with whom I speak frequently, Brent, is a resignation, perhaps, that the policy shift that many traders were hoping for probably isn't coming here. The rhetoric out of the administration has been pretty clear on their anticipation or their process now.
Yes. So news is being factored. Well, a lot of it's factored in. So real news, real significant shifts can certainly potentially move the market, but this expected stuff is less likely to have significant impacts on the market right now. So when we're watching news, it may not sound good, but you got to ask yourself how much of that is expected versus not.
Fair. Yeah. Okay, Brent, real quick, we're going to look at the Russell. We're not going to dabble too long here because this chart is just really tough to deal with, but you can see the same thing that we've talked about with the SPX and the NDX. We've made a new range over the last week, and in terms of just monitoring that range and trying to dictate the next potential directional move in the Russell, it's probably a break of those white lines to some extent here.
Yeah, I mean, think of it as a flag pattern. In bear flags, you have the flagpole where it's gone down, kind of maybe the sideways-ish range where we have this where your horizontal lines are. If we start to break out, that's your new flagpole forming, perhaps. And of course, the flagpole target that you can potentially draw isn't no guarantee it's going to go down there. Of course, it's just an idea. But the general flag pattern we've seen for a while on this rut, where it goes down, consolidates, goes down, consolidates. We're in a consolidation period. At some point, it's going to go down, consolidate, and then reverse back up. That's why we want to see that break of the upper line. Yeah. Right now we're kind of flirting with the bottom line, though, I've got to say, especially on the rut.
You're absolutely right. We really are. And I just realized that I don't have my lines properly color coded. So let's make them resistance now, because they once were support. And once we've fallen through that, we're going to have very little option but to call that potential resistance zone. So the 20-day has been pretty consistent on the Russell now for a while, Brent. We can go back, basically been below it. So for quite a while, back to February 11 here on the Russell. Big move. Now let's move off of this and look at yields. We had a question there from Carol about what's been going on with the 10-year. And she calls out the fact that pundits across the board have been a little bit confounded with the moves we've seen here in the 10-year. I'm going to drill in just to about the last 9 months or so, but let's talk about this. What do you see, and what are your thoughts on these volatile swings in the yields?
Yeah, so it's a good question for Carol. One I'm not sure I'm going to have a satisfactory answer for you on, Carol. But what we've seen is a decline in yields, which means there's been more, for the most part, until the last few days. Okay, we'll get to the last few days in a sec. We've seen a decline in yields, which is probably expected in a way, because more people are buying up bonds. When people buy bonds, it drives the price of bonds up and it drives the yields down. Why do they buy up bonds? Well, if you're nervous about the stock market, nervous about equities, often people will buy bonds. Okay. So, but the crux of Carol's question is, why then, over the last few days, have yields gone up? And I don't have, it's kind of a weird thing, I admit, but one potential answer is there's maybe a little bit of a fear that of some bond investors that there's going to be less of an appetite by foreign entities of U.S. treasuries. They're going to be less desirable. U.S. Treasuries. And therefore, the price of bonds is going to go down and yields are going up. And that's kind of one possible explanation. By no means is that I'm saying, that's a definitive truth. I don't know exactly what that is, but that's one possible explanation, because it is a little bit of an enigma as to why bonds have gone down and yields have popped up the last few days.
Yeah, it is an enigma, but speaking to, as you just did, I mean, just trying to get a picture for why we might be seeing what we're seeing. I think it speaks to the concerns as it relates to the recession fears, right? I mean, that's ultimately traders and those holding U.S. Treasuries may be getting a little less comfortable doing so and preferring to sell rather than purchase, right? And granted, there's only going to be so much interest in acquiring safety at some point. So we'll see exactly how that plays out. It is notable to me, if nothing else, the move we've made today may have broken the downtrend line in yields. So if yields are going to continue to climb, boy, does that put a bit of a another color code, another bit of context over things, right? I mean, my goodness, I'm just thinking that dropping yields is good for other areas of the market, Brent, but maybe not if we're going to keep running.
Yeah, presents a more of a challenge, because if you're an equity investor and you're looking for alternative investments, one kind of logical place sometimes is bonds, and if bonds aren't going up, then that's not making that as desirable there. But yeah, and yields, as you all know, yields certainly can affect things. Especially if you're a home buyer or want to refinance mortgage, or you own a business and you want to refinance debt, that's problematic.
Yeah, and there's a lot of conversation around that being part of the administration's policy approach, is in an effort to get yields lower. Then that will allow us the opportunity to refinance so much of the debt that we're sitting with right now, which of course we know is at all-time highs. And if we can, and I think we're looking at a major tranche of that debt becoming due, if you will, in next year, 2026. And the thought being that if we can reduce rates, well, then we can get a refinance on that debt. Then we can save a boatload of money that way. But that remains to be seen as to whether it can play out that way. Certainly, if we're going to break rate yields to the upside, that's not exactly going to work. Now, there is, of course, a lot of discussion around the potential for rate cuts coming. You're absolutely right, everybody. If we take a look at where we stand in the CME Fed tool, for example, which is by no means a lock, it's just how traders are positioning. The look right now, Brent, suggests as much as a 100 basis point move between now and the end of the year. So expectations have risen for more rate cuts here, all tied to the expectation of tariffs and the potential to put us in a bit of a rough spot here, right? So we've seen this shift quite a bit in the last couple of weeks.
Yeah, just two comments on that. One, the drop in the expectation, or the expectations of more significant rate cuts, probably more tied to suggestions or anticipation of economic slowdown, rather than just like sometimes they can drop more in expectation of lower inflation. This is probably more tied to expectations of economic slowdown. Also, another thing is rate cuts don't necessarily coincide with a dropping in the U.S. in the yield on like the 10-year Treasury. When did we get the first kind of significant rate cut from the Fed on this chart that you're looking right now? It was, look at that September low right there. That's when the rate cut occurred. Yeah. Look what happened right up. Did rates go down? No, rates went up. So there's not this one-to-one correlation between those. So just be aware of that.
Excellent point. I'm glad you brought that up. We cut rates at the bottom, basically. We were around 3.6, and then we watched them rally 100 basis points plus. So, okay, that seems notable. I do want to point out the VIX is dropping a little bit. For those of you watching, one of the charts that I've built over the last week and a half here has really just been putting together side by side with a two-chart grid, for example, just an S&P 500 on the left VIX on the right, and watching how they move. When the VIX breaks down, certainly 50 is going to be a level, everybody. In fact, intraday, if we can get under about 48, you might start to see further lift in the S&P 500. But Brent, this just reminded of the significance of this move. What we don't want to see is the continued elevation of volatility index here. I'm just hearkening back to the way things happened in COVID, for example. The VIX remained elevated for a month. And it was elevated such that it held a 10-day moving average for the entirety of that time frame. So if we were just to give a snapshot here and change my moving average from the 20 to the 10 real quick, give you guys something to look for in terms of, hey, maybe the VIX is going to come back to earth. But you can see, Brent, this is a very clearly elevated VIX nonetheless.
And you know, you probably don't need the VIX chart to tell you there's a lot of uncertainty and fear in the market. You know, that people call the VIX the fear gauge and whatnot. And so, yeah, and so there's a couple things. One, it measures fear. Two, there's a high correlation between the VIX and what the market itself is doing in terms of price performance. Mm-hmm. And so it's a little bit of a chicken and the egg type thing of, you know, the VIX is high, markets have been going down. Well, if as the VIX lowers, markets are steady and are going up, or is it the markets steady or go up and the VIX drops? They're kind of coincident to one another there. But this certainly shows us that there's a lot of uncertainty in the market right now. So it's, you know, Carol said in the chat, I'm cheering for 47. It's not often you say, I'm cheering for 47 on the VIX, but that's the state we live in right now.
That is a good reminder. I thought, here, everybody, let me just add that extra bit of time, and I'll just bring you back to how things felt in 2020, for example. Here was our COVID spike. If I drill into it, this is what I'm talking about. See how elevated the VIX got? And we got over into 40. Oh, goodness, we're over 50, and we just kept pushing. So this was a good illustration of the type of potential move that we might be undergoing here. And I bring it up because if it is as significant of a development that what we're looking at is a long-term shift in markets, international markets, or the collective global markets, well, then we could very well be given a little bit of insight to that by the VIX remaining elevated for an extended period of time. Any last thoughts on that, Brent?
No, I mean, the VIX stays elevated as long as the uncertainty continues. So if it's a quick spike in uncertainty like we saw with the yen carry trade thing last year, then the spike is quick and it resolves quickly. COVID, there was a lot of uncertainty for a while as to what the economic impacts were going to be, and so it stayed elevated for a while. In this case, right now, it's, you know, I have no idea how long this uncertainty is going to remain elevated.
You and me both, sir. Okay, let's pull back to a more near-term ledge. Let's look at what's going on 1 year, 1 day. Let's talk briefly about the semis, and then let's look at some of these sectors and potential moves. Semis broke down, and one of the things that I've been thinking about of late, Brent, was really, you know, yes, the semis have broken down now, but the semis were giving us plenty of heads up along the way, weren't they? I mean, they peaked in July of last year, and then ultimately after that peak have gone nowhere for the better part of the next 6+ months, and then we got moves to the downside. So it seems to me like the SOX was giving us a little bit of a heads up, and maybe we weren't paying enough attention.
Yeah, the SOX can be kind of a bellwether for the market, and so it is something that we want to pay attention to, but it could potentially lead us up to when things turn around, but we're not at that point right now. So in fact, there was a question earlier in terms of sectors, and in fact, I think Cam just answered that in the chat. Which sectors are going to do better in a lowering rate environment? And yeah, Cam answered that, and so there are some that we traditionally look at there. But part of you got to ask part of the reason why it's lowering. Is it because there's economic slowdown, recession in people's minds? And if it is, then defensive sectors, traditional defensive sectors like staples, may tend to do better in that. Not that they're going to do well necessarily, but they may outperform versus versus those that are more the cyclical sectors as well. But you can also look at it from the factor of just like borrowing costs and stuff like that, which is another way of looking at that. And then you can look at financials and real estate and utilities and things like that.
Yeah, you're right, Brent. Having a basic understanding of what many investors consider to be defensive groups, those being, as you called out, staples. We could also throw healthcare in there, commonly a bit of a defensive group, as are utilities and real estate, apt to do better when yields are dropping. You'll notice they are in the red today because we had that big spike in yields today. So that makes a little bit of sense. But when yields start to come down, investors are going to feel, hey, maybe we go a little bit heavier into utilities and real estate. I'll take on a little bit of additional exposure from a risk standpoint to own higher yields. That's why investors see a flight to utilities, to real estate as yields drop. There's a balancing act as always, and it's really just figuring out where is that level, under what level in yield do we start to see traders really prefer the risk opportunity, or does a risk appetite come to play when thinking about utilities and real estate, for example? So I think those are the big ones: healthcare, staples, real estate, utilities. But a good way to know as to how that is moving in the moment, one of the things I like to bring up is just a couple of quotes pages that I've separated here, Brent, and it's just look at the S&P 500 11 sectors with a 21-day relative strength, and then the same thing with all the industry groups with this 21-day relative strength. And I'm just reminded, Brent, that this is, again, an understanding of how traders are perhaps positioning during the uncertainty here. And I'll remind us, even though when we talk relative strength does not mean profits necessarily, does it, Brent? It could just be less losses than other spaces in the marketplace here.
Yeah, I mean, I don't think there's any sector you're going to look at right now, a graph, and go, ooh, that looks great, but it's just kind of in comparison to one another, huh?
Yeah, exactly. So if you're looking at keeping an eye on things, this is possibly a good way to do just that. Remember, you can detach your quote windows, park them on another monitor, let them run, and just keep a close eye on things. And then when it's time and you're ready and you want to act, you just drill into one of these groups specifically by changing your drop down and going to the industry itself, and either selecting all of the industry or drilling into the sub-industry groups if you find that those are opportunistic for you. So another good way of just kind of keeping an eye on things. Let's move back over to the charts there real quick. There's your staples look, finding an area of potential support, kind of an interesting spot for a bounce there on staples. Then I also thought we needed to peek in on IT, which of course is getting a bit of a pop. We're seeing some of that volatility come back in the form of upside moves right now. So this isn't terrible, but Brent, that 20-day moving average overhanging us pretty well here. I think I need to change that back to a 20-day if I'm not mistaken. So
well, it probably doesn't matter what moving average you use, Kevin, whether you use a 5 or 10 or 20, they're going to look fairly similar. They'll be 5 or 10 will be a little closer to what we're currently at, but it's yeah, it's the trend is the same, the pattern is the same. I don't know that I have that much more to say on that one, to be honest.
Yeah, I understand. That's fine. I mean, obviously, we've been saying a lot of the same things together for quite some time. So, all right, let's look at a couple of other areas. Somebody mentioned that, Bitcoin is always a concept of risk on, and the market found potentially a spot for intriguing support. Brent, I'm going to change this to my 2-year and look at that level. Some intrigue about that ledge we found with today's intraday low around 75.
Yeah, and that is interesting. You can see that on the shadow on the candle there. That's right about where we hit. So we'll see if that holds. The general trend is still going down on this. Um, it is an this is an alternative investment. Crypto is an alternative investment, but there's some alternative investments that tend to perform better when there's more economic uncertainty, such as like gold typically or something like that.
Sure.
Bitcoin's kind of newer on the scene, of course, but this is well, another way to characterize it is there's risk on and there's risk off alternative investments. And this is more of a risk on alternative investment. In this case, it's obviously not performing very well. We'll see if that support level holds. We've broken through that 200-day moving average recently.
Yeah, we're fighting it out, it would seem, right at that 200-day moving average, ballpark to about 78,000 or so. So, again, as a proxy for just risk appetite, I think that's an interesting way of looking at Bitcoin. We won't talk any further about really in the trend detail here. Let's move off of that, Brent. What do you say we get to some stocks in the news this morning? Believe it or not, there are stocks in the news for reasons other than
Yep.
We have upgrades, we have some downgrades. Let's look at let's lead with the bad news, if you will. Let's look at Ford, which Bernstein downgraded today to underperform from market perform. They put a new price target on Ford at $7. Of course, everybody knows the story here. And I'm just left to wonder, hey, Bernstein, appreciate the downgrade. Why did you wait till now? I mean, it's not like Ford's been doing excellent.
Yeah, we've dropped not quite 50%, but we've gone to the better part of that over the past several months here, past year. Well, yeah, I mean, that's a downgrade and it's sold off. We'll see if we can. I mean, today's candle, at least we're intraday, we're battling on that, but that is that's I don't know what to say on that, Kevin. It's not that. I mean, the volumes have been going up. You can see that by the way, on not just Ford, but on a lot of these others. Take a look at the volumes. The volumes have spiked, which is understandable when the market is dropping here.
Wow.
And we'll see. You'd expect volumes to maybe mellow out a little bit here. That is one sign among many that we can look at as in terms of some acceptance of the market sell-off at that point. But at this point, we're still dropping, volumes elevated, and the trend is down.
Yuck. One positive, when you're trading at 8.5 a share, it only takes 85 cents to move 10%. So,
yes.
I guess you could take that, but obviously we're not seeing a whole lot that's anything other than a bearish downtrend and with a new low. I mean, this is a multi-year low today. Dating back all the way to, whoa, what a shock. A lot of these moves, Brent, 2020, not a surprise. Okay, so there's a downgrade there, and then there was a downgrade on out of Jefferies on some of these hotels, parks, etc. So they downgraded Host Marriott today, another one where we've already seen the slippage. This has been pretty obvious. Not to suggest that I called this out, but I certainly haven't been watching this, but look at the move against the 20-day here, Brent. They got downgraded to hold from buy, new target at 14. That's down from 20. But Jefferies also downgraded Park Hotels and Resorts, ticker symbol PK, along with the Xenia Hotels, XHR. So they've been downgrading a multitude here. And again, Brent, you've seen price action leading us this way.
Yeah, and this is again, it's kind of closing the barn door after the horses are out, I guess. But in this case, probably not a surprise. I didn't read their specific reasons for the downgrade, but if indeed there's more and more people talking about a recession, if not an official recession, a significant slowdown, people are less likely to travel and use hotels, and businesses, if they're pinched, are less likely to send people out on business travel and whatnot. And so probably not a surprise that we've seen that general direction in hotels and resorts of late.
Mm-hmm. Yeah, I have to agree, Brent. And very generically, the comment out of Jefferies analysts was citing macro and market uncertainty and decelerating global travel.
Yep.
That all sounds like it stands up to reason to me as well.
Yep.
So heads up there, everybody. How about some positives? Let's look at how about Apple? We got an upgrade on Apple overnight. Jefferies did upgrade Apple to hold. Previously had been at underperform. New target at 167.88. That's down from 202.33. Again, this is a different situation, Brent. The move to the downside has been substantial, and the level to which Apple has fallen also notable on a longer range view here. I'm going to add some heat, but Brent, tell me some details, what you're thinking about when you're looking at Apple and what's going on.
Well, Apple, as I understand it, is the worst performing of the Mag 7, if we're still calling them that this year. Is that, well, maybe, I don't know. I mean, Tesla, I guess, would be, if that's a Mag 7 technically.
Sure.
It's hard to believe it's doing worse than that. But anyway, they're not doing well. We have some potential support levels down there. And at a certain point, there's valuation issues, that people will find it a more attractive thing from a valuation. But yeah, the concern, I know there's some chat in our chat on how much iPhones would potentially cost in the future. And that certainly makes it more challenging because that's a big part of Apple's business. We'll see if we can catch some support there today, even despite the, we're up 3% based on the upgrade there. That's a weekly chart you're on there, I guess.
It is.
And so you can see the shadow on that candle. We're well off that. So that's a good sign, I guess.
Yeah. And I guess the level to monitor is this 165 down below. I mean, we were there last spring. We were there the summer or the fall prior. There's been a bounce zone. Okay, this is the definition of support. Doesn't mean it has to hold, but it does mean that moves under those levels tell us quite a bit about expectations moving forward. And it would be a very significant development should Apple break under 165. The risk factor there is substantial, Brent. Under 165, we start looking for, next levels of horizontal support, and we could be looking at, another 15 to 20%, believe it or not, to the downside, just from a technical perspective. Not to suggest that it has to make those moves, but if you're a trader thinking, hey, I'm going to look for the best case scenario, my encouragement is to say, sure, I love the positivity. But you gotta, when we're talking risk on our underlying positions, it's imperative that we consider how much further could this go? Where does my comfort get tested? Those are the conversations you want to have with yourself in the midst of these types of moves, I think.
Yeah, and I just looked it up. The estimate is iPhones account for 42% of Apple's market cap. So that you can see how if they're sourcing expensive product, if it's going to drive up the price of products for that, how that can, really affect the company.
Yeah, no doubt about it. Another one that got upgraded briefly here, everybody, because we're short on time. I'm going to hit you up with a chart on Starbucks. Starbucks also upgraded by Jefferies to hold from outperform. New unchanged price target is at 76 here. Retreated about 30% from the February market peak. Analysts suggesting that the downside is near-term limited. Still believing that Starbucks' fundamental turnaround here takes a longer period than the market generally believes. And of course, tariffs adding to complexity and risk. Couple others that we saw, Brent, J&J, we were talking about healthcare a little bit. So J&J getting an upgrade out of Goldman Sachs, upgrading to buy from neutral, new target at 172 here. Interesting zone of support that it may have found.
I thought looking at that.
It's been a really long range, kind of a technical pattern there, huh?
Yeah, it has. That's a channel down, a trend down. So, but our recent bounce was near pretty close to where our bounce was the most recent one there. Yeah, right in there. So if that level is holding, that's a good sign there. You can see the bounce back January into year time frame there. We held that. So maybe that's a good sign to start, Yeah, when you get a turnaround, sometimes it's these subtle little signs. It's got to start with those, and eventually, maybe some others kick in. But that's a first step, I guess.
That's right. Everything starts with a trickle. Not likely necessarily to start with an avalanche of moves, perhaps. So, as always, little stair steps along the way. Upgrades also today for Keurig Dr. Pepper, Travelers Group, Constellation Energy, Bath and Body Works. The reason I'm mentioning them just broadly is as a reminder of the groups, right? Healthcare, staples, and in insurance there. Travelers also upgraded. So some intriguing details of late. Good walk away here from Zinc 560. Better times are going to be available.
Just thinking that.
Have a plan, know how you want to handle it, and never forget it's okay to get up and walk away from the screen, right, Brent?
Absolutely, absolutely. And we do have earnings season upon us here coming up, so that's something to look for over the next coming weeks.
That's right. Yeah, starting next week in earnest, if I'm not mistaken. But obviously, we're going to be listening very, very closely to the conference calls and the details coming from those, as we probably hear a lot about expectations relative to tariffs and so forth. So lots to keep your ear to the rail on here. Keep it tuned right here to the Schwab YouTube coaching channel. Obviously, much more to come from us today and the rest of the week. Big thanks to Cameron May there in the chat, and a real big thanks to all of you for being here and participating in the show, asking your questions. Follow the three of us on X. Give us a thumbs up down below if you like today's conversation, everybody. We're going to get this one reviewed and out there for the masses here shortly. So we greatly appreciate you helping us boost the segment for everybody that hasn't had a chance to watch it yet. So as always, we appreciate you joining. Hope you all have a great rest of your week. We look forward to seeing you all again real soon.